Throughout this video, we will be going more in depth on how approved revenue for an operation is decided, what a coverage level is, and how to decide which one is right for you, and how the insurance guarantee is calculated. Let's take a closer look at approved revenue. One question producers often ask is why WFRP doesn't simply insure whatever they expect to earn in the coming year. The answer comes down to managing risk fairly. As we discussed in the last video, approved revenue comes from comparing expected revenue and historic revenue. The expected revenue comes from the upcoming insurance year based on their current farm plan. The farm's historic revenue is usually based on the previous 5 years of allowable income and adjusted for growth when appropriate. Using the lower figure helps the policy reflect a realistic revenue expectation and not an overly optimistic production estimate. This approach ensures that production is provided against legitimate revenue losses and securing the most accurate amount of revenue in the event of that loss. It is also important to remember that claims cannot be finalized immediately after harvest. Because whole farm revenue protection relies on verified financial records, claims cannot be completed until the producer has filed the appropriate tax records for the insurance year. In this example, we see an operation with a 5-year historic average of $500,000 and an expected revenue of $450,000. The approved revenue is taken from the lower of the two numbers, so expected revenue becomes the approved revenue. The same would be true in the opposite situation. Suppose a diversified Idaho producer has averaged $500,000 in allowable revenue over the past 5 years. For the coming year, grain prices have increased and cattle futures are strong. Based on these favorable market conditions, the producer estimates that they could earn $550,000. Regardless of this, because the lower value is used, approved revenue for the coming year would be based on historic revenue of $500,000. Once approved revenue has been established, the producer's next decision is selecting a coverage level. This decision determines both the amount of protection provided and the cost of the insurance premium. Think of WFRP coverage levels like choosing a deductible on your auto insurance. If you choose a higher deductible, your premium is lower, but you absorb more of the loss before insurance pays. If you choose a lower deductible, your premium is higher, but insurance begins helping with the smaller losses. Producers should select a level that matches their operation's financial situation, risk tolerance, and overall management goals. Some producers are comfortable assuming more financial risk in exchange for lower premiums, while others prefer paying a higher premium to receive greater protection if a major revenue loss occurs. Finding the right balance is an important part of designing an effective risk management strategy. Let's examine what each coverage level actually means. At the 50% coverage level, the policy protects half of the farm's approved revenue. Because the producer is assuming a larger share of financial risk, premiums are generally the lowest at this level. Coverage levels between 55 and 65% also provide moderate protection while keeping insurance costs relatively affordable. These levels are often selected by producers who have multiple sources of income or who can absorb moderate revenue fluctuations without significant financial hardship. Many operations choose 70 to 75% coverage, which represents a balance between affordability and protection. At this level, the policy covers most significant revenue losses while maintaining manageable premium costs. Moving to 80 or 85% coverage provides substantially greater financial security. These higher levels protect against more severe production losses, market declines, and other insured causes of revenue reduction. However, because more of the farm's revenue is guaranteed, premium costs also increase. And finally, 90% coverage offers the highest level of protection currently available under WFRP. With only 10% of approved revenue remaining uninsured, this level significantly minimizes financial exposure but comes with the highest premium. Ultimately, producers should carefully evaluate their cash flow, debt obligations, operating expenses, and overall financial goals when selecting a coverage level. Insurance should complement the farm's overall risk management plan, rather than replace good financial management. Once the approved revenue and the coverage level have been selected, the insurance guarantee can be calculated. As long as the farm's allowable revenue remains above that guarantee, no payment is triggered. If allowable revenue falls below the guarantee due to a covered loss, the producer is eligible for an indemnity. Everything that happens during the remainder of the insurance year is ultimately measured against this guarantee. Let's walk through a complete example. A producer has a historic revenue of $500,000 and an expected revenue of $550,000. The lower value of $500,000 is used for allowable revenue, and they have selected a 75% coverage level. Multiplying the approved revenue by the coverage level gives us the insurance guarantee, so $500,000 multiplied by 75% equals an insurance guarantee of $375,000. That $375,000 is the point that a producer may qualify for an indemnity payment. It's important to emphasize that this is only a guarantee of a portion of the farm's revenue. It is not a guarantee of profit.